This is the Bloomberg Daybreak, your podcast available every morning on Apple, Spotify or wherever you listen. It's Wednesday the 10th of April in London. I'm Caroline Hepker.
And I'm Stephen Carroll. Coming up today, markets wait to see if the US inflation print delivers the Goldilocks data the Federal Reserve is looking for.
A major ratings agency goes negative on its outlook for China's long-term foreign debt pile.
Plus, making ends meet, the UK's financial regulator warns more than 7 million people are struggling to pay their bills.
Let's start with a roundup of our top stories.
The March inflation figures in the United States, due out later, are unlikely to settle the debate around when the Federal Reserve will cut interest rates. Economists surveyed by Bloomberg are expecting a slowdown in the pace of price increases, with the core reading, which excludes food and energy, rising 0.3% in March month on month. Investors are now evenly split on the prospects of a first Fed cut in June, with many traders unwinding dovish bets on significant cuts later this year. But Bloomberg Opinion's Mohamed El-Arian expects the central bank's overall trajectory to remain unchanged.
I think Chair Powell has made it very clear that he's willing to look through these bumps. They will need overwhelming evidence that it is more than a bump in order for them to change their views. Inflation will be sticky. Inflation will be absolutely sticky. We're going to get stuck at around 2.5% to 3%. And I do think that that actually warrants, over the long term, the Fed rethinking its inflation target.
Mohamed El-Arian also telling Bloomberg he expects only 2 rate cuts this year from the Federal Reserve. And the message from CEOs is that the Fed will need to ease this year, despite the ongoing strong performance of the US economy.
Now, Fitch has cut its outlook for China's long-term foreign debt from stable to negative. The ratings agency says that rising economic uncertainties have eroded fiscal buffers. Although Fitch sees government debt increasing in the coming years, it did affirm the country's A+ rating.
Apple more than doubled its production of iPhones in India last year as it pushes to build up its capacity outside of China. Bloomberg has learned the US tech giant now makes about 1 in 7 of its smartphones in India, worth $14 billion in its last financial year. China remains Apple's largest iPhone-making hub and biggest overseas market, but revenues there are plunging. The jump in activity is a win for Indian Prime Minister Narendra Modi, whose government has given companies, including Apple, major financial incentives to boost manufacturing there.
Now, millions of people in the UK are struggling to make ends meet. That's according to a new survey of British adults, many of whom are falling behind on domestic or credit commitments. Bloomberg's Ewan Potts has the details.
Some 7.5 million people in the UK are struggling to pay their bills. That's a big drop from the almost 11 million who were in the same position at the start of last year, but it's still higher than the number before the cost of living spiralled after the pandemic. The estimates come from a survey by the Financial Conduct Authority, who says that more than 2.5 million adults are relying on debt advisors and charities for help. The regulator is making permanent a COVID-era requirement for lenders to do more to support borrowers in difficulty. Its efforts are sure to be put to the test as inflation and higher interest rates continue to squeeze households. In London, Ewan Potts, Bloomberg Radio.
The crisis at Thames Water is prompting fears about other UK utilities. The risk premium on newly issued bonds in the water sector has widened by as much as 13 basis points. James Woolcock has more.
Thames Water is special. It's the largest and most indebted of all water companies in Britain. Its owner Kemble's default rating was downgraded to CC yesterday by Fitch, and it emerged Britain's Environment Secretary rejected a direct appeal for intervention from shareholders. But a lot of UK water companies have high levels of debt, inflation-linked bonds, and poor operating performance. That's got some fixed income traders wondering if Thames is the large, messy canary in the coal mine or sewer. In London, James Woolcock, Bloomberg Radio.
Britain's Foreign Secretary says that the UK won't suspend arms sales to Israel, but demanded more aid to be sent to Gaza immediately. David Cameron made the statement during talks with politicians in the United States.
We want to see 500 trucks a day. We want to see the water switch back on. We want to see Ashdod and a northern crossing point opened. And crucially, we want to see this deconfliction, because getting aid to Gaza on its own isn't enough. You've got to be able to get aid around Gaza.
Cameron's words were echoed by US Secretary of State Antony Blinken, who stood next to him.
What matters is results and sustained results. And this is what we will be looking at very carefully in the days ahead. And that includes making sure that the assistance that gets into Gaza is distributed effectively throughout Gaza.
These joint comments come after months of rising international concerns over the death toll in Gaza that have increasingly isolated Israel on the world stage. Turkey yesterday announced fresh restrictions on exports to Israel, further straining already tense relations between the one-time military allies.
Meta is downplaying the threat posed to this year's elections by disinformation created by artificial intelligence. The company's under pressure to ensure AI-generated social media content doesn't interfere with voting. The company's head of global affairs, Nick Clegg, says they haven't seen evidence of that yet on their services. Meta announced plans last week to label all AI-generated content on Facebook.
And those are your top stories this morning.
In a moment, we'll get more on today's US inflation numbers and bring you details of a controversy over information sharing from the government agency that publishes the data in the US. But it's not the only thing that we've been reading this morning.
No, absolutely. I wonder whether this is of interest to you because you've spent so much time living in France, of course, which is one of the rare countries that brought in a 4-day work week as mandated. I think it was
35-hour working week.
35-hour work week. That was back in 1998, right? It's quite a long time ago. So it's one of the few places where there's actual data on this. But apparently this is an idea now that Bernie Sanders over the United States is thinking about bringing in. He wants to see a 4-day work week in the United States. The thing is, the way that it is being thought about in the US is causing quite some controversy. And so Alison Schrager's been writing about this. Basically, the bill that Bernie Sanders seems to be putting forwards is limiting the number of hours that people work by not paying them overtime also. And so there's sort of an issue about whether it's just going to add to costs in the US.
Yeah, I mean, this would be looking at a 32-hour working week. So the idea being that if you split that down into 8 hours is that it would be 4 days rather than current. I mean, France is an interesting example because the 35-hour working week came in and was meant to increase employment. That was the idea. If you know, you'll create more jobs because people are working fewer hours. But in practice, what the average working week in France isn't that much shorter than it is anywhere else in the OECD if you look at the statistics. And the reason for that is that most companies, if you're paid by the hour, yes, it means that overtime kicks in over 35 hours. But if you're someone who isn't paid by the hour, what happens is you just get a few more days off a year. It's called RTT, and it's the way that factored into companies' leaves. It is an increased cost for companies, but the legacy, and this is long debated in France as well, is what the legacy of the 35-hour working week is. It didn't help materially to create extra jobs in France. But it is something that, look, this is feeding into a broader debate about how technology is going to impact work in the future. And the argument that Alison Schrager makes in this as well is that, you know, Keynes predicted that people will be working a 15-hour working week back in 1930 because he felt that technology was going to be such that people would need to be spending less hours at work. She does believe the trend will be for people to work fewer hours because they work fewer hours now.
Soon does
they did in 1930. But putting limits on it, that's the debate that she feels, is that putting a number on it and making it perhaps an imposition on companies could actually hurt the economy now versus later. We know this is a debate. Think about the hybrid working debate that's been had since the pandemic as well, about how people are able to keep their employees for longer in a tight labour market. Labour retention becomes very important as well. Perhaps it's something that will come from an incentive side from companies instead, is they'll offer people more possibilities to be able to spend fewer hours in the office, perhaps work less over time. I think Alison Schrager's point is we shouldn't expect to see it anytime soon.
No, although she does point out that we have been trending lower in terms of hours worked. You know, it has been a standard for many, many decades, as you say, since the 1930s. But actually, working hours have been pared back even without legislation. So this particular bill that she's, pointing to in the US from this, from the Vermont senator that we all know, of course, she's saying maybe it doesn't need to be imposed by legislation, that it will sort of happen naturally. Anyway, so it is an interesting argument, often had across Europe. The 4-day work week on the Bloomberg terminal this morning.
Well, let's turn to today's US inflation report. Likely to show the hot readings of the previous 2 months are the exception rather than an alarming trend. Bloomberg Economics expects both headline and core CPI to slow to 0.3% in March as a change from February. Joining us now to discuss is our Markets Live strategist, Mark Cranfield. Mark, great to have you on. What are we expecting today then from the CPI numbers?
Should be a modest lowering in terms of the core number, but really only a very small one. Headline may actually go slightly higher than it was the previous month. Overall, the data isn't likely to make a dramatic change to the outlook. As far as the Fed is concerned, it's heading in the right direction, but not particularly quickly. But traders have already seem to be anticipating that there's a risk of a slightly hotter number. So bond market seems to have got itself pretty short number of leverage players, building up quite large positions there. People are reasonably long of the US dollar as well. So if anything, there's more risk that people will be a little bit disappointed if the number came on the low side. So we could see dollar weaken a bit and treasury bonds rally. Equity market, it would need something really substantial outside of the range, because the equity market is more concerned about earnings. Season is just getting away. Got banks coming up later this week. And of course, tech sector is doing pretty well. So it's more about the currencies and the bond market really today.
Yeah, absolutely. We've also really seen the kind of wind taken out of the sails of traders betting on 3 Fed rate cuts this year. So that's the other big, obviously the huge component will be around that. The betting now is 65 basis points of cuts this year.
Yes, it's June is the one that seems to be a bit of a coin toss at the moment. Still some way to go, of course. There's going to be a couple more inflation numbers and PCE numbers before we even get there. But clearly there's some kind of split between the Fed, and we've got a lot of speakers still to come this week. We've got people like Mr. Bostic, who last thing he said he was looking for maybe only one cut. We've heard people still saying that 3 is possible, and all kinds of things in between. The people will probably want to see a bit more data until they all coalesce around one place. Jerome Powell seems to be one of the most dovish himself, but he certainly hasn't managed to form a consensus among the Fed people. So for that reason, traders will probably continue to stay on the fence in terms of June. July looks more likely if there's going to be an interest rate cut, and the Fed have got plenty of time to send the messaging clearly on that. So even after today's CPI, it will probably be that July is still favoured for the first rate cut.
Of course, it is still a data print that's very closely watched by markets. And I wanted to get your take, Mark, on this controversy about equal access to the CPI data. This after documents from the Bureau of Labour Statistics has published it shows that there was communication happening behind the scenes with the likes of JP Morgan and BlackRock and so-called super users of BLS data.
I'm not in a position to comment specifically, but the minute you see anybody supposedly getting preferential treatment, it's going to be a story that runs and runs. There's going to be a lot of potentially unhappy people on Wall Street. If that is the case, they'll have to do some kind of inquiry, I imagine, because if it's seen to favour anybody on an important economic data, there'll be a lot of gnashing of teeth on Wall Street about that one.
Yeah, indeed. Emily Little, who's the Associate Commissioner of Publications and Special Studies, the BLS, says they are under this exchange of messages is under review. They say that it has been an embarrassment for the Bureau of Labour Statistics, and it's their goal to repair that trust as data providers put a lot of trust in them for the data that they provide to be secure as well. So that is something that's going to be still under review. The BLS economist in question didn't respond to messages from Bloomberg seeking comment over that story. So that is, I suppose, another aspect of the story that we're watching as we look ahead to today's US inflation report. Yeah,
absolutely. So the US inflation report drops at 1:30, but we also do get a 7 p.m. Fed minutes. Mark, is there anything to be passed out of those minutes that come out 7 p.m. London time, I should say?
Usually not too much. Enough time has passed since the last meeting. There's been a lot of Fed speakers in the meantime. Jerome Powell himself, everyone's been giving their opinions. So I think the market it will take a lot to surprise traders in the minutes, considering how many people have spoken in the meantime. And we're still very split on what number of rate cuts are coming. And the data in the meantime has been relatively strong as well. So it's very backward looking. It would take a shock in the minutes to really surprise anybody.
This is Bloomberg Daybreak Europe, your morning brief on the stories making news from London to Wall Street and beyond.
Look for us on your podcast feed every morning on Apple, Spotify and anywhere else you get your podcasts.
You can also listen live each morning on London DAB Radio, the Bloomberg Business app and Bloomberg.com.
Our flagship New York station is also available on your Amazon Alexa devices. Just say, Alexa, play Bloomberg 1130. I'm Caroline Hepker.
And I'm Stephen Carroll. Join us again tomorrow morning for all the news you need to start your day, right here on Bloomberg Daybreak Europe.